welcome to TheoTrade. This is Don Kaufman. It's August 30th, 2019, and you are watching the TheoTrade Weekend Update. So, this past week of trade, well, listen, we're still living in volatility land and loving every single minute of it. You know, I know a lot of you kind of tuning in, you're like, wait, what? We just moved up, okay, over 70 S&P points throughout the course of the week, which, by the way, was precisely what we were looking for in terms of expected move, which I'm going to cover here in just a couple of minutes when we take a look at the chart, is that, you know, you see this rip, roar, and rally, and you think to yourself, that was totally unforeseen. Quite the contrary, people. Listen, the expected move, what was it last weekend when we talked about it? It was precisely 70 bucks. What kind of move did we see in the S&P futures? What kind of move did we see in the SPX? It was, for the most part, spot on. In fact, we even mentioned it in Wednesday night's video. In Wednesday night video, we were talking about, hey, like, listen, we hadn't moved all that much on Monday, on Tuesday, and Wednesday. So we anticipated that Thursday, okay, Friday, might be some rockin' movement in the markets, and we got just that. The S&Ps took off to the upside on Thursday. But I got to tell you, you know, when you think of volatility, most people think of implied volatility, right? Which is really, okay, what the options market is depicting risk to be. But for right now, push that aside, because in a couple of moments, we're going to look at historical volatility, which is the annualized standard deviation of past stock price movement. That's an exciting definition you're never going to need. Basically, what it means is actual price movement. And I got to tell you, when I started looking at historical volatility, which I haven't looked at in quite some time, it's a little bit astounding. Again, it makes you kind of rethink everything you know about volatility. What's astounding about it? I mean, for the most part, when you look at historical volatility, again, actual price movement in the markets, the only thing you have to compare it to recently is when you got to go back to like October, November, and December of 2018. Which was a rockin' ride in the markets, people. And you'll notice something interesting, though, is that the movement that we've seen as of just the last couple of weeks in this marketplace, it's just as vicious to the downside as it is to the upside. The other big one that I want to throw out there to you is that the implied volatility, which we'll also depict here in a moment, the implied volatility, which is option markets, again, depiction of future risk, it refuses to kind of back down. So you know what I'm talking about, like living in the land of volatility and loving it. What I'm talking about, first of all, historical volatility is heavily elevated. Implied volatility, what do I mean by it's elevated? Well, this past week of trade, we saw a $70 expected move, and we got every single ounce of that $70 move. This coming week, by the way, we're coming into a holiday weekend. You know, happy Labor Day, everybody. You made it through another summer. But this next week of trade is down to none other than 4 trading sessions. U.S. markets are effectively closed on Monday, so you're down to 4 trading sessions. You know the interesting thing about 4 trading sessions? You have almost a $60 expected move. So you have this rockin' week with a $70 expected move, but the market rallies. And usually when the market rallies, volatility, that is implied volatility, contracts. It didn't contract. I mean, for the most part, you're sitting on the same kind of, you know, big bag of risk as that you were the previous week. What gives? How about we're entering into the month of September? You like that one? In the month of September, things have tendency to happen. We're also still in this tweet-twastic kind of world that we live in. Listen, there's a lot to cover into some of the charts, some of the trade ideas. With that, let's get to it. To the charts and trades we go. Sticking with this weekend's theme, we're trapped in volatility land and loving every minute of it. I mean, what that kind of breaks down to is just take a look at the expected moves as of late. Now, for those of you who are a little newer here, you haven't necessarily tuned into TheoTrade. Each and every week, we kind of define right here in the SPX what the options market depicts risk to be. Okay, moving forward, again, kind of week over week. And this past week of trade, we were looking for this $70 move to the upside or $70 move to the downside. There's absolutely unequivocally, there's no directional bias. And that central line right there, that's where the week starts out. So as I said just moments ago in the video section, I mean, we just tagged every ounce of a $70 move. And as we went up, and up quite substantially, the volatility didn't really collapse. And that's kind of typical for option markets. Usually when you go up in the market, that is, the marketplace goes up, volatility typically contracts. Well, you know what? When you start looking at the VIX, and we'll cover a little bit of this later, but when you start looking at the VIX, did you see the VIX? Did it really come off much this week? And the answer is absolutely not. So back over to the SPX, there's a couple things I want to point out. Again, one of them being, we warned you of a very substantial move likely to come, and we warned you on Wednesday evening. On Wednesday evening, we even said, like, listen, okay, this is as far as we've moved. We're only up about, 30 some odd points on the week. We have $70 of movement very likely, and we got every, again, ounce of that. Now, I also alluded to placing trades, okay, around the edge of that expected move. Okay, did you do it? And when I say did you do it, if you took a look at the trades that we placed here at TheoTrade, well, one of the trades that we placed right there, okay, we told you about it. We paid 95-cent debit for a, 29.10, 29.20, 29.30 call fly. We sold that thing for $3.50. The irony is I probably could have held on to it a little bit longer on this Friday and taking that trade off for about $6, but hey, you know what? We hit our percentage gain, okay, of what we intended to. This is an expected move butterfly. We took it, we ran. Nevertheless, the SPX adheres to the edge of the expected move. And, something, again, I was pointing out on Wednesday, and almost every single week, and literally almost every single week this entire year, okay, we've hit at some point throughout the course of the week, we've hit the edge of the expected move. What I mean by that is, once again, when you start looking week over week, here's a week we crack through the edge of the expected move. Okay, here's a week where we crack the edge of the expected move, touch the edge of the expected move, touched it. Here we touched it almost to the bottom. I mean, it's not spot on, but when the marketplace says it's going to move $70, or for example, the marketplace this coming week says it's going to move 60, okay, do not take that for granted. Literally, don't take that for granted. Understand that means that we have, again, a wide berth in this particular case of movement possibilities. And again, this coming week, you only have 4 trading days, and yet we have, and I'll take you directly over to the SPX, okay, the expiration, of course, would be none other than September 6th. We have just about a $60, again, a $60 expected move between now and, of course, next Friday. And again, I wanted to note that because it looks a little high given the fact that we just saw, the 70-point plus rally in there. The next thing that I was kind of bringing up here on the video portion had everything to do with historical volatility. And that's why I kind of said, like, redefine what you know about volatility. Things are getting a little bit more serious. We're going to come down over here to studies. We're going to go add study, volatility studies. We're going to cruise right up to historical volatility, the annualized standard deviation of past stock price movement. Listen, I'm not tweaking anything in the historical volatility. It's just average over the last 20 days. I'm going to close up this left side bar. I'm also going to snap this chart out just a 3-year, again, a 3-year daily, because what I wanted to bring to your attention is, listen, that was just wild volatility. What was that? That was in early of 2018. That's what they called the VIX explosion, right in this neighborhood here. Okay. Then we, of course, had, October, November, and then December in late 2018. Just wild times. Now, remember, okay, what I am referring to this market right now, I'm referring to it as a volatility box. The irony of that is that's exactly where we currently are. In terms of actual price movement, we're moving as much, okay, as right before we actually snapped out of the volatility box and things just got downright crazy. Keep this in mind, because you know what? When you're in these ranges, and we are in a range right now, and you know what? Do us a favor. I'm actually going to snap back over to the spider so we don't have a lot of lines to deal with. But when we're in, okay, a tight kind of range like this, and everybody tends to fall asleep, this is our volatility box. Don't get off your game. I'm telling you right now, you do not get off your game right now, because this is no different. Okay, it's no different than what we saw back here. I'm also going to bring it over to the S&P futures to kind of further this conversation for just a second. Literally earlier this morning, there was an assumption being made that we were just going to pop right out the upside of that volatility box. And, one thing that we've learned, okay, from these ranges recently, and again, the upside of this range is somewhere right around 29.40. We pierced it just momentarily. We pierced that effectively today. One thing we've learned about these volatility boxes is hitting the top of it, we are just as likely to revert back down, okay, and tear it up in the marketplace as explode to the upside. And again, I need not look any further. Okay, I need not look any further. Just scroll back a little bit in time and you'll see the exact same things playing out. All right. It's just at a slightly different level. And again, I'll zoom out so everybody gets a better orientation for this. Okay. Look, there's no difference between the move we saw here, the move we saw here, the move we saw here. These were all trying to pierce the upside of a really tight volatility channel. It's no different than what we're seeing right now. Okay, again, volatility, redefine it, because the action to the upside right now is almost as vicious to the downside. All right, so as we were saying, the volatility box, it remains intact. We pierced the upper edge of it for a brief and fleeting second. But hey, listen, with this kind of action in the marketplace, you can very well expect just to come back down, touch the downside of this. The longer, okay, and I want you to remember this, the longer that we're channeling back and forth like this, okay, the more vicious the move is going to be when we effectively do crack to the upside or the downside. Now, that's that big question. Okay, and when I say the big question, the really big question right now is everybody's mind like, well, are we going to be the upside or the downside? Okay. Listen, we're a tweet away. We're an ECB announcement, a Fed announcement, a Fed speech away from exploding higher or lower. Okay, and I don't mind telling you this. This marketplace is completely binary. It's a coin flip. That's what binary means. All right, you're going to be a 0 or you're going to be a 1. It's a coin flip away from a drastic move higher or lower. But one thing that we do know about these little volatility boxes, because we've been in many of them, okay, in recent years. You get wound up, and the longer you in this, the tighter it gets wound, okay, and the more harsh that break is going to be. And I think that historical volatility tells, okay, a much larger story as, again, we're building up in actual price movement, and yet we're in an ever tightening kind of range in here. It's dangerous. I know you don't like to hear that this is a binary move, but I'm going to come back to that here in just a minute. Now, let's move on. Bonds? Well, they're backing off. Kind of. All right. What does that really mean? Well, let's actually cruise over to the bond market for a second. If you take a look at bonds as of late, listen, we've got a nice big year chart over here. They're trading into never land, right? It's the never-ending story, pretty much, of bonds. The irony is when you start looking at the bonds, okay, can you find more than 2 down days in a row in any recent history in the bonds? Huh? Because I really can't. I mean, you have to start to go back all the way, okay, to July timeframe to find 1, 2, 3 days back to back that were down days inside of the bond market. Now, I know some of you that are technical analysis experts will probably say, but this is 1, 2, 3 days. No, we actually on the bond market. Yeah, I'm sorry to ruin it for you. We finished higher today. Okay, it doesn't matter. It's a red candle. We still finished net higher than we opened. So what do you got? It's like a doji star. All right, another doji. It's doji fun inside. Listen, the bonds, okay, don't count them out. The bonds, even if they were to make a big move to the downside, you have to realize that a lot of sovereignties, right? Germany, for example, and Japan now being the largest holder of U.S. treasuries, they're going to look at that and they're like, what a deal. The other day I had to pay $165 for them. Now I'm $160 and change. They may bid that right back up over here. It is difficult at this point in time. I refuse to take a contrarian position inside of the bond market. Now that speaks volumes about what I kind of think in the overall marketplace, because I'm telling you, I have a tough time with the idea of bonds really selling off and selling off big. What would it take for a big bond sell-off? Okay. Major change in policy, okay? The Chinese and the U.S. trade war comes to a crashing end. Immediately, it would take, again, a vast announcement to get these bonds to come off. Because as of right now, everybody, listen, the search for yield is on. And when our bonds are still paying, like 2% net, looks pretty good. Looks pretty good compared to, negatively yielding bonds out there. So the bonds are backing off, kind of. Now, we also have, okay, along with those bonds, a little bit of a hawkish tone coming out of the ECB. You know, the ECB, they've still got Mario Draghi in the seat. Then, of course, we're going to switch over to Christine Lagarde, which I believe is the October-November timeframe. There's going to be a new head to the ECB. Now, Christine Lagarde is absolutely dovish. Okay. However, there is the equivalency of, again, we have all these different like Fed presidents here in the U.S. Well, the ECB has very, very similar kind of structure, and other individuals, not the head of the ECB, which of course is Draghi, okay, other individuals inside the European Central Bank have actually spoken out this week, and they said, no. Okay, I'm not ready to start up the quantitative easing again. We're not going to go out there and buy bonds just yet. And they had a absolute tone to them that said, no, forget it. Meanwhile, okay, they're going to wait to see if Germany is officially in a recession, I would say, before that they start to, light up the quantitative easing program. This could be a big nothing over here. One thing, though, I have to tell you, I'm rather surprised the markets did not react negatively to that hawkish tone, right? Markets right now, what do they want? They want free money. Give me my free money. Give me negative interest rates. It's a wonderful thing. Now, right with that, we have financials ripping higher. Or is it just a quintessential bounce? Well, let's actually tune into the financials. For that, we're going to go to the XLF. I'm at least going to start with the XLF. Then we'll go onward and upward thereafter. If you take a look at the XLF, it has a rip-roaring week. We're back above 2650. Okay, listen, this is no different than the volatility box. We're just to the upper edge of that volatility box. The weird thing is, and we're going to talk about this, the risk markers are not backing down. So at this point in time, okay, I believe it's just that quintessential, kind of rip your face off rally that ironically, this move to the upside may not necessarily be moved to the upside at all. Effectively, you could call this the bearish bounce, dead cat bounce, whatever you want to use. Okay, it is the quintessential rip your face off rally, though to the upside could very well be short-lived. And again, what do we have to compare it to recently? You know what? Everybody likes a little bit of comparison every now and again. I'm going to snap this out to like a 3-year. What was the marketplace looking like, all right, back in that volatility box that we saw, again, just some months ago, right in the same neighborhood? Except the financials were even more volatile in October and November and December. Okay, it's the exact same neighborhood. Welcome to the neighborhood of 2650, where, again, rip your face off rallies are going to be relatively frequent. All right, so the next thing on our list over here, why won't risk markers back down? All right, and everybody needs to question this. Okay, the risk markers, they're not backing down. When I say a risk marker, all right, the VIX just won't contract. You just saw, again, kind of a rip your face off rally, and net. Let's just be very, very forthright with this. In fact, I'll even use the spiders to clean up the chart a little bit. Net. This is a marketplace. Come on, it's unscathed. The all-time high, it's right there. Where are we right now? Right here. All-time high, right here. All-time high, right here. Yet the VIX, okay, the VIX, that's things, it's not backing down a whole lot, right? The all-time high, you would think the VIX would be trading the 12 region, the 14 region, the 10 region. No, we're actually just shy of the 20 region. Why? Because nobody trusts nothing coming into September, October, November. Okay? The Fed doesn't even know what to do at this point. The volatility futures, they're saying very much the same thing. They have backed down even less. I mean, the volatility futures, if you look at these vol futures, and we're actually going to zoom out for a second on those volatility futures. Okay? For the most part, the 19-day volatility futures are sitting almost identical, okay, almost identical to the 47-day volatility futures. Go a little bit further out in time, and we're actually still in a backwardation. And what a backwardation is the, look, the 47-day contract is above the 82-day contract, which says more risk in the near term than in the further term out. All right, moving along from there, that's the volatility futures. Then we're going to come all the way down to the VVIX, the volatility of the volatility index, which professionals are apparently still bidding up volatility. Enough said on that front. The bonds, okay, well, we just discussed the bonds a moment ago, but think of the bonds, okay, as like a risk on, risk off. Well, apparently there's still a feel of risk in the air. Then we can actually cruise over to gold. Do I need to keep going? All right, because I can go all day long on this front. Take a look at gold. Oh, gold almost had 3 down days in a row. Okay, nevertheless, it still looks like the bonds. it still looks like the bonds over there. And then for a little bit of a side note, if you take a look at utilities, yes, utilities, once again, an all-time high. If this is a risk marker, it's all over, people. It's all over. And then the dollar. Last but definitely not least, why don't we go to the dollar? The dollar decided to trade into Never Never Land today, much to the dismay of pretty much everybody in the Treasury. The dollar is on fire and continues to approach that 100 level. You got to open up a 3-year chart to see this kind of action. I mean, hey, listen, net, we appear, to be in a volatility holding pattern. You got to choose your positions carefully. You got to define your risks, and you better love your delta. Effectively, what I'm saying in that statement over here, when you start looking at the broader marketplace, people, there's still a tremendous amount of risk. And as I said, this is a very binary marketplace. We could explode higher, explode lower, on a hair, on a tweet, on anything. Know what your overall delta risk is. When you go to your monitor tab or you go to your analyze tab, and I talked about this on incessantly in some of the recent videos here, know what your net risk is going to be. Individual stocks, they don't matter as much. You'll notice in these videos, I'm like, what about Facebook? What about Amazon? What about them? Nothing matters right now when you're inside the hurt locker. And what's that? I mean, that's effectively like, looking at the marketplace right now and recognizing the hurt locker. We're just in this tight range. We're going to explode higher, explode lower. The correlations here are almost 100%. It doesn't matter what you trade. Everything is moving right now with the broader marketplace. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.